The market is currently closed. SoFi Technologies Inc. closed the last session at a price of $26.55 on Friday, September 12, 2025. This closing figure marks the end of a remarkable week for SoFi, one that saw it flirt with and ultimately surpass its 52-week high. The immediate assumption, and the one many investors are currently holding, is that this rally is simply a continuation of the post-earnings momentum driven by their stellar Q2 report. However, that's only part of the story, and it's a dangerously simplistic view. The deeper, more compelling reality lies in the tectonic plates shifting beneath the fintech sector, and how SoFi is positioning itself to not just survive, but thrive in an environment that is now actively punishing its competitors. While everyone is celebrating the high watermark, they are missing the subtle but critical signals that show SoFi is fundamentally de-risking its business model in a way that its peers are not. And this is the true engine of its recent stock performance. It's the silent transformation from a high-growth, high-risk lender to a diversified capital-light financial institution. This subtle pivot, which is gaining traction and being recognized by institutional money, is the real reason for the stock's outperformance. And it's what differentiates the current rally from past, more speculative runs. The recent price action in SoFi stock has been a masterclass in market psychology. For months, the narrative surrounding the company was one of a high-risk tech stock, heavily reliant on its lending business and vulnerable to interest rate fluctuations. This expectation was deeply embedded in the stock's valuation, keeping it in a volatile, range-bound pattern even as it showed signs of operational improvement. Then came the second quarter earnings report. SoFi delivered a monumental beat on both the top and bottom lines, with EPS of 8 cents against an expected 6 cents, and revenue soaring to a record $858 million, blowing past the $804 million forecast. The market's reaction was swift and decisive, sending the stock surging over 16% in pre-market trading and fueling a multi-week rally. But what the surface-level analysis misses is the why. It wasn't just the numbers, but the composition of those numbers. The critical insight, the true reality that is now changing investor perception is the massive surge in fee-based revenue, which grew a staggering 72% year over year to $378 million. This figure is not just a number, it is proof of concept for SoFi's long-term strategy, the so-called financial services productivity loop. It shows that the company is successfully monetizing its massive user base through its other, less capital-intensive services like SoFi Invest, SoFi Money, and its technology platform business. This shift is what's attracting new investor demographics, from growth-oriented hedge funds to more traditional long-only institutional investors who were previously wary of the stock. For a long time, the dominant narrative was that SoFi was simply a student loan and personal loan company with some other stuff tacked on. Now the data from the Q2 report is challenging that very notion, proving that the other stuff is a powerful, high-margin, and rapidly growing engine of its own. Drilling down further into the recent dynamics, the trading volume has been exceptionally high, indicating strong conviction from both retail investors and institutional players. The stock hit a new 52-week high of $26.63, a level that for many was unimaginable just a few months ago. This is a clear indicator that the market's expectation of SoFi as a perpetual show-me story is being replaced by a reality of a company delivering consistent and accelerating profitability. The fact that the stock has held its gains and continued to push higher in the days following the initial earnings pop rather than fading signals that the buying is not a short-term knee-jerk reaction. It's a re-rating of the company's long-term value. This is where the tension between expectation and reality becomes most apparent. The long-standing bearish argument was that SoFi's path to sustainable profitability was murky, that its lending business would always be subject to the whims of the macroeconomy and regulatory changes, and that its other ventures were a drag on earnings. The Q2 report shattered this expectation by showing a path to profitability that is no longer solely dependent on the lending arm. The strong performance of the financial services and technology platform segments, which together grew revenue by 74% year over year, is the kind of detail that institutional investors pore over. This is a business evolving from a cyclical lender to a diversified capital-light fintech ecosystem. For those who are just now looking into the SoFi story, it's worth understanding the core business model. SoFi, short for social finance, is a modern digital bank and a one-stop shop for personal finance. Its main revenue streams historically came from its lending business, offering personal loans, student loan refinancing, and home loans. But the company has been on a multi-year journey to build out what CEO Anthony Noto calls the financial services productivity loop, which essentially means getting a member into one product, say a student loan, and then cross-selling them into others like SoFi Invest, SoFi Money, and SoFi Credit Card. SoFi Invest is its online investment platform, offering everything from stock trading, including fractional shares, to automated investing through an intelligent portfolio. This is a direct play on the burgeoning trend of self-investing and the shift away from traditional brokerage houses. The company also has a technology platform, Galileo, which it acquired to provide the back-end infrastructure for other fintechs. This is a critical and often overlooked part of the story. Galileo is a high-margin, sticky business that generates a predictable stream of revenue, and its continued growth solidifies SoFi's position as not just a consumer-facing brand, but a foundational part of the fintech industry itself. Past performance was characterized by heavy investment in these areas, which led to significant losses, but now those investments are beginning to pay off, as evidenced by the record profits. Looking ahead, the future outlook for SoFi is framed by several key catalysts and risks. On the catalyst side, the company's full-year guidance raise for 2025 is a powerful signal. SoFi now expects to add at least 3 million new members this year, with adjusted net revenue of approximately $3.375 billion and adjusted EBITDA of around $960 million. These are not modest increases. They represent a bold declaration that management believes that momentum is not only sustainable, but accelerating. The market's anticipation of further interest rate cuts could also provide a tailwind for the lending business, potentially boosting profitability even further. For those of you who engage in online investment, this is the kind of forward-looking statement that drives conviction and separates a momentum play from a long-term hold. The ongoing success of their SoFi Invest platform, competing directly with giants like Fidelity Investments and newer players like Robinhood, will also be a key metric to watch. If SoFi can continue to grow its active trading and robo-advisory user base, it will further diversify its revenue and prove the effectiveness of its integrated financial services model. The potential for a continued student loan refinance boom as macro conditions normalize is another massive opportunity that many are underestimating. On the risk side, competition remains fierce. While SoFi has built a powerful brand, it is still a small fish in a very big pond. Established players like Fidelity and their diverse offerings, from Fidelity ETFs to Fidelity mutual funds, pose a constant threat, as do agile startups and even other fintechs like Interactive Brokers with its platform built for seasoned traders, or Robinhood's user-friendly app. The biggest risk, however, is a potential economic downturn that could lead to an increase in loan defaults, which could reverse the progress on profitability. Furthermore, the high-flying valuation means that any future disappointment could be met with a swift and severe market correction. To truly understand SoFi, you have to look beyond the stock price and see the evolution of the business. It's a story of a company moving from a niche lender to a full-fledged financial services company, a transition that is far from complete but showing signs of remarkable success. This journey is the true reality that is now replacing the old market narrative. It's a company that is not just adding members, but deeply engaging them across a suite of products, creating a sticky ecosystem that reduces churn and increases lifetime value. This is the ultimate goal for any fintech. Comment below how many shares of SoFi you currently hold and what you think its biggest growth driver will be over the next year. Will it be the lending business, the technology platform, or the financial services segment? The current market perception is that SoFi's future is secure, but the reality is more nuanced. While the company has made incredible progress, it still operates in a highly competitive landscape. The recent surge in stock price is not just a reward for past performance, but a bet on the successful execution of a very complex and ambitious strategy. The expectation was that SoFi would struggle to become profitable and diversify its revenue. But the reality, as shown by their Q2 report and the subsequent stock movement, is that they are doing both and doing so at an accelerating pace. This is what makes the SoFi story so compelling and so worthy of attention.